Taxes are a fact of life, but did you know there are legal ways to reduce the amount you owe each year? In today's video, we're going to uncover some of the best strategies to save money on taxes. By the end of this video, you'll have actionable tips to keep more of your hard-earned money in your pocket. So, let's get started. Understanding tax deductions and credits. What are tax deductions? First, let's understand what tax deductions are. A tax deduction reduces your taxable income, which in turn reduces the amount of tax you owe. By lowering your taxable income, deductions can significantly decrease your tax bill and help you save money. Common deductions include those for mortgage interest, charitable contributions, medical expenses, state and local taxes, and certain educational expenses. Tax deductions come in two main forms: the standard deduction and itemized deductions. The standard deduction is a fixed dollar amount that reduces the income you're taxed on. The amount of the standard deduction varies based on your filing status. For example, in 2023, the standard deduction is $13,850 for single filers and $27,700 for married couples filing jointly. Most taxpayers opt for the standard deduction because it simplifies the tax filing process and often results in a larger deduction than itemizing. However, if your eligible expenses exceed the standard deduction, you might benefit more from itemizing your deductions. Itemized deductions allow you to list specific expenses that the IRS considers deductible. These can include mortgage interest, property taxes, medical and dental expenses that exceed a certain percentage of your income, charitable donations, and certain unreimbursed work-related expenses. Itemizing requires more record-keeping and documentation, but it can lead to substantial tax savings if your deductible expenses are significant. For example, if your taxable income is $50,000 and you have $5,000 in deductions, your taxable income drops to $45,000. This means you'll pay taxes on $45,000 instead of $50,000. What are tax credits? Next, let's talk about tax credits. Unlike deductions, which reduce your taxable income, tax credits reduce the amount of tax you owe directly, making them an incredibly powerful tool for saving money on taxes. A tax credit provides a dollar-for-dollar reduction in your tax liability, which means that a $1,000 tax credit saves you $1,000 in taxes. There are two main types of tax credits: refundable and non-refundable. Refundable credits can reduce your tax liability below zero, resulting in a refund. In other words, if the credit exceeds the amount of taxes you owe, you will receive the difference as a refund. Non-refundable credits, on the other hand, can reduce your tax to zero, but not below that. This means they can bring your tax liability down to zero, but any excess credit is not refunded to you. Let's dive into some common tax credits to understand how they work and how they can benefit you. One of the most well-known refundable tax credits is the Earned Income Tax Credit, EITC. The EITC is designed to benefit low to moderate income working individuals and families, particularly those with children. The amount of the credit varies based on your income, filing status, and the number of qualifying children you have. For 2023, the maximum EITC ranges from $600 for individuals with no children to over $6,000 for those with 3 or more children. Maximize retirement contributions. Contribute to retirement accounts. One of the most effective ways to save on taxes is by contributing to retirement accounts like a 401k or an IRA. Contributions to these accounts are typically tax-deductible, meaning they reduce your taxable income. This dual benefit of tax savings and long-term financial security makes retirement accounts an essential part of any tax-saving strategy. Let's start with the 401k. A 401k is a retirement savings plan offered by many employers, allowing employees to save and invest a portion of their paycheck before taxes are taken out. For 2023, you can contribute up to $22,500 to a 401k if you're under 50, and $30,000 if you're 50 or older. This additional catch-up contribution is designed to help those closer to retirement age accelerate their savings. Consider a Roth IRA. Another option to consider is a Roth IRA. While contributions to a Roth IRA are not tax-deductible, the withdrawals you make during retirement are tax-free. This can be a great way to save on taxes in the long run, especially if you expect to be in a higher tax bracket during retirement. Take advantage of health savings accounts, HSAs. Benefits of HSAs. Health savings accounts, or HSAs, offer a triple tax advantage. Contributions are tax-deductible, earnings grow tax-free, and withdrawals for qualified medical expenses are also tax-free. For 2023, the contribution limits are $3,850 for individuals and $7,750 for families. If you're 55 or older, you can contribute an additional $1,000. HSAs are a fantastic way to save on taxes while covering your healthcare costs. Utilize education tax benefits, education tax credits. If you or your dependents are pursuing higher education, there are tax credits available to help offset the costs. The American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC, can provide significant savings. The AOTC offers a maximum credit of $2,500 per student for the first 4 years of higher education. The LLC offers a credit of up to $2,000 per tax return for tuition and related expenses. These credits can reduce the amount of tax you owe and even result in a refund. Student loan interest deduction. Don't forget about the student loan interest deduction. You can deduct up to $2,500 of interest paid on student loans each year, reducing your taxable income. Optimize your filing status. Choosing the right filing status. Your filing status can have a big impact on your tax bill. If you're married, you can choose to file jointly or separately. In most cases, filing jointly provides a larger standard deduction and more tax benefits. However, there are situations where filing separately might be more advantageous, especially if one spouse has significant medical expenses or miscellaneous deductions. Consider your specific circumstances and consult a tax professional if needed. Head of household status. If you're unmarried and support a dependent, you might qualify for head of household status. This status offers a higher standard deduction and more favorable tax brackets compared to single filers. Keep track of business expenses. Deductible business expenses. If you're self-employed or own a business, keep meticulous records of your business expenses. Many expenses, such as office supplies, travel, and equipment, are tax-deductible. Additionally, you can deduct a portion of your home if you use it for business purposes. This home office deduction can provide significant tax savings. Retirement plans for the self-employed. Self-employed individuals can also benefit from retirement plans like a SEP IRA or a solo 401k. These plans allow for higher contribution limits than traditional IRAs, reducing your taxable income while saving for retirement. By understanding and utilizing these tax-saving strategies, you can significantly reduce your tax burden and keep more of your money. Remember to stay informed about tax laws and consult with a tax professional to ensure you're taking full advantage of the deductions and credits available to you. Thank you for watching. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more financial tips, and share it with your friends. Happy saving!